Thanks for showing up on the most beautiful day of the winter to a room without windows. So I'm Herschel Naklis from the Department of Government and Rockefeller Center for Public Policy. It's a great pleasure to welcome you today to Jonathan Levy's talk titled Instability and Inequality, American Capitalism at the Volcker Shock of 1980, in a program sponsored by the Political Economy Project and the Rockefeller Center. So as many of you know, Professor Levy is a professor of history at the University of Chicago and a leading historian of economic life in the United States. A graduate of Yale and the University of Chicago, he's the author of numerous articles in the award-winning book, Freaks of Fortune, The Emerging World of Capitalism and Risk in America. Today's talk is drawn in part from his new forthcoming book, Ages of American Capitalism, a history of that subject from the 17th century to 2010. Now, these are, of course, huge subjects. They require an unusual range of expertise in history, economics, finance, politics, law, culture. They require an unusual ability to synthesize. And as students in my seminar discovered last night, in conversation with our speaker, there are few people able to relay such subjects of such scope and detail so clearly. So I just want to share one scene from the chapter that my class read, a different chapter in the book, that's worth relaying for displaying these features, but also because of the scene's deep connections to Dartmouth College and the state of New Hampshire. So the scene is from September of 2008. We're in the heart of the financial crisis. The American economy is on the brink. Senate leaders, including New Hampshire's Judd Gregg, are working with Treasury officials like Treasury Secretary and Dartmouth alumnus Hank Paulson to try to stave off the abyss. Levy writes in this chapter, quote, Paulson and Bernanke traveled to Capitol Hill to lobby Congress. Bernanke told 20 members of Congress, quote, I spent my career as an academic studying Great Depressions. I can tell you from history that if we don't act in a big way, you can expect another Great Depression, and this time it is going to be far, far worse. That night, Paulson's staff overheard him vomiting in his office. Later in these negotiations, Paulson visited Senate Democratic leader Harry Reid in his office, and Reid asked Paulson if he should call a doctor, as Paulson dry-heaved into Reid's office trash can. Now, I relay this section not to credit the 1960s Dartmouth from which Paulson graduated with teaching the future Treasury Secretary about the various uses of trash cans, but rather as but one example of Levy's work. Here we find one of the most important figures in contemporary economic history responding to a generational crisis not only with logic, models, and data, but with the features and flaws so characteristic of human behavior at such critical junctures. And today, Professor Levy will talk about another such critical juncture, economic policy in the 1980s, both its successes and its shortcomings. So please join me in welcoming him to Dartmouth.
Good evening. Thank you for the introduction, Herschel. Thank you to all my hosts for this visit. Thank you to all of you for coming tonight. Indeed, yesterday I visited Herschel's class on inequality. We spoke about the Great Recession, and I shared a chapter I've written about the Great Recession for a book that I'm now finishing that will come out this year with any luck. That's a history of American capitalism from English colonial settlement in the 17th century through the Great Recession. And just saying that out loud, I feel tired, just sort of thinking about the scope of the enterprise. But indeed, the Great Recession, the moment, I think, within which to locate the Great Recession, and I don't think, we talked about this yesterday, that the Great Recession with respect to the economy has changed very much. The moment, still our moment, I think begins in the early 1980s. Let me say just a few words about this book that I'm writing. The approach that I take in the larger book is to put the history of capital at the center of the economic analysis. In particular, the composition of capital and the history of the process of investment in different kinds of capital. So I examine in the book a lot the history of markets, the history of exchange, the history of labor, history of production, entrepreneurship, innovation, the history of consumption, but it's investment and shifts in investment that are the key, at least for the way that I try to do it. Now, if investment is the lens, then money and finance becomes very important. There's a tradition in economic thought, it's just one tradition among many, that defines capital as a factor of production, And capital then plugs into production functions alongside labor. And capital and labor can be substituted out at the margin. They can be exchanged. So this definition of capital as a factor of production, basically as a factory, if you want to put it more nicely or clearly, is a very restrictive definition of capital. It's not wrong by any means, but I think it's incomplete. And if you're a historian, and I am a historian, a broader definition that can encompass money, can encompass objects of investment like slaves, land, thinking about the broader economic history of the United States, a broader definition I think is called for, including money, right? Money. So post-1980, I see a change in the composition of capital towards more money-like or financial and intangible assets, away from fixed physical factors of production. Now, the cause of this shift, as I see it, is among the owners of capital, who are charged in a capitalist economy with the task of investment. Among the owners of capital, a higher liquidity preference. Now, I'm about to get into some juicy history. This is Paul Volcker. I'm going to talk about him in a second. I'm almost there. But liquidity preference, I'm sure many of you in the room would know, comes from John Maynard Keynes. It comes from his 1936 book, The General Theory of Employment, Interest, and Money. And I always kind of can't help but thinking along with Keynes in my own work, even when I try. But where Keynes said in this book, and I'm going to paraphrase, he said it's best to not think of capital as a factor of production, but as an asset, a legal asset, that yields a future pecuniary income, and in which, among the different possible capital assets, there's a spectrum ranging from liquidity to illiquidity. So what's liquidity? What's liquidity? So first, a liquid asset is an asset that does not depreciate across time. It's a secure store of value. And therefore, it's a refuge from uncertainty, a secure store of value that's a refuge from uncertainty. Second, a liquid asset is one in which there's always a willing buyer, right? So it's always marketable, always convertible. So liquidity makes capital mobile. It's not solid, it's not fixed, right? Capital can flow. So on that spectrum, money is the most liquid asset. The most illiquid, probably, would be a giant, big, rusting, depreciating factory, right, with fixed running costs, a factor of production. So in the history of capitalism, I argue there's been a kind of oscillating dynamic between investment in liquid assets and then investment in illiquid capital assets. With illiquidity, you get long-term investment in factors of production. You get labor, you get wealth generation, you get innovation, you get productivity growth. Liquidity, you have a short-term orientation. You can park wealth in money and wait for sort of precautionary reasons. There's a financial panic, you can hoard cash or a money-like equivalent. Right? Or you can also, with liquidity, move capital around quickly. You can convert it instantaneously for purposes of short-term speculation. Right? So over here, illiquidity, long-term investment. Over here, liquidity, short-term, involving both speculation but also kind of precautionary hoarding. So what our financial system does today, what it's great at doing today, is not so much, right? Not so much investing capital long-term in illiquid assets. It's great at creating, actually generating financial assets with the attributes of money that are liquid. And with respect to the Great Recession, you would want to talk about those synthetic mortgage-backed securities. They're precisely the kind of liquid asset our financial system is very good at generating. Okay, so after 1980, I argue we see an increased liquidity preference among the owners of capital, an increased desire to not, right, to not be burdened by fixed commitments in place, right, to keep investment options open. And we have a larger political economy that's geared around that preference, and which itself exhibits many of the attributes of liquidity. So liquidity preference is somewhat of a technical concept from Keynes, and I'm going to try to broaden it out perhaps too much as a mode of explanation for many other parts of the political economy, and also social and cultural life in general, beyond just the specific quality of capital. Okay, so let me actually try to explain what I've been talking about, and then why after 1980. So what happened, right? What happened? So if you want to talk about liquidity, you have to talk about money. If you want to talk about money, the action is here with this guy in the U.S. Federal Reserve. So I want to just jump into a moment in 1982. And what I'm going to do is read from the transcripts of the U.S. Federal Reserve's Federal Open Market Committee meeting. This is July 1st, 1982. And presiding was its chair, this man here, Paul Volcker. And so the Federal Open Markets Committee is charged with setting interest rates, charged with setting U.S. monetary policy. So I'm going to read, but let me set the stage. In July 1982, there was a Mexican peso currency crisis. So Mexico was at risk of defaulting on its sovereign debt. The Mexican peso was under attack by global currency traders. And this is July 1st, 1982. The Fed's debating whether to extend a $600 million credit line to Mexico, which is really just a bridge loan to get to an even larger bailout from the IMF, the International Monetary Fund. So I'm going to pick this up from midstream. Fed Governor Ford, I'm quoting, $600 million is peanuts. If we want to help Mexico, the hope is we can get at the element of the flight of capital. Chairman Volcker, I don't know what's going to happen with regard to the flight of capital. In some ways, it's surprising that Mexico hasn't had more. On the other hand, one can make the argument that nobody thought anything was going to happen before the election, so the capital flight will come after the election. Mexico was going to have an election that fall. I'm back with Volcker. So listen, we can all speculate about everything. I don't know how to do this. What is the amount of debts from American banks to Mexico alone anyway? Vice Chairman Solomon, 20-odd billion. Chairman Volcker, wow, that's big. Governor Ford, the way I understand Mexicans is that they think of themselves as being on the brink of or already in the class of industrialized nations, and the view is that only so-called developing countries go with hat in hand to the IMF, getting instructions on how to behave. Says Governor Martin. You mean developing countries like the United Kingdom? Okay, so the Fed would approve that $600 million credit line. That last reference to the UK, was bailed out in 1976 by the IMF. It was very humiliating for the UK, and it was the largest IMF bailout until 1982 in Mexico, a nearly $4 billion bailout. And there's going to be in this era many, many more, including Mexico again in 1994, which was a $50 billion IMF-coordinated bailout, and it just iterates and iterates and iterates until it culminates in the bailouts of 2008. Let me say a few more words about this. Volcker, we can speculate about everything. I don't know how to do this. Don't we all have days on the job where we feel like we don't know how to do this? There's no shame in that. And actually, reading these transcripts from Volcker's chairmanship, he does this over and over again. Sort of time and again, he tries to vocalize like his own consciousness of a fundamental uncertainty that's being wired into a global economy in which he, chairman of the Fed, Volcker, if anybody, is supposed to have responsibility. Right? So that's one aspect of this idea of liquidity preference, like this emphasis on uncertainty and the inability to kind of think about and plan for and direct and create a long-term economic future. Okay, Volcker is put in that position in terms of mythology, of being all-knowing and all-seeing. Was the first Fed chairman to occupy that role in the public imagination. Alan Greenspan, the so-called maestro, takes it to new heights in the 1990s. Under Volcker, U.S. monetary policy became the central arena of U.S. economic policymaking and also global economic policymaking. And it's really remained both to this day, absolutely. Now, this responsibility was originally dropped into Volcker's lap. President Jimmy Carter nominated Volcker. At the time, Volcker was the president of the New York Federal Reserve Bank, Fed chair on July 25th, 1979. This was just after Carter's really last gasp effort to revive the U.S. economy, which was suffering from stagflation, both high unemployment and double-digit inflation in the 1970s. Carter's sort of last gasp attempt had failed for many reasons, but one, in response to Carter's attempt to coordinate an international macroeconomic stimulus among the G7, there was a speculative attack by currency traders against the U.S. dollar. So after the end of the Bretton Woods era in 1973, the U.S. dollar is now floats like all currencies in global currency markets. You can see here the direction of the line in the late 70s. The U.S. dollar plunges dramatically, and Carter really blinks. And New Deal liberalism, it's been in crisis for decades, is really over. Months after this, Margaret Thatcher becomes Prime Minister of Britain, and Carter announces a new policy of macroeconomic decontrol, as he put it, deregulation, tax cuts, and also fiscal austerity. So basically, Carter turns the stagflation crisis over to the Fed and says, you fix it. Now this Time magazine cover, this is just months after Volcker's appointment. And it's illuminating. You can see the lines kind of go up, they go down, they go sideways, they go backwards. Right? So a collapse of predictability, a collapse of a sense of macroeconomic control, a collapse of even a sense of kind of straight line historical time and direction. Right? A kind of pulling back from a long-term future and into this highly uncertain present. I mean, we clearly, with respect to economic history, entered an era defined by these lightning-fast global capital movements across space, including across national borders. It's not an era explained so well by staged, linear narratives of economic modernization. Modernization, either the capitalist variety or even the communist. You can see Castro's kind of peeking out here from the corner. Now, the squeeze of '79 refers to what subsequently became known as the Volcker interest rate shock. In October '79, Volcker surprised the White House. He also surprised the markets by adopting monetarist doctrines. I'm not going to say too much about that, besides to say with monetarist doctrines, the Fed no longer targets a short-term interest rate and controls it. Rather, it targets an aggregate quantity of money, and then it lets the interest rate settle in the market. So what happened to interest rates? Well, at first they go up, and that's important. But also, I think this is a monthly average here. They fluctuate dramatically day to day. Right? They create a lot of uncertainty in financial markets because they're so volatile, in addition to being high. Because the rates go up, because the crunch in credit, it brings about a very sharp double dip economic recession. 1980 lasting 80 to 82. It's shaded here on the graph, which helped, among other factors, bring Ronald Reagan to office. Volcker finally ended the monetarist experiment in 1982, and by then the Volcker Shock had finally whipped inflation, which in 1983 fell to nearly 3%. This is inflation expectations, which is the index that Volcker used. Volcker actually was trained at Princeton as a kind of an Austrian economist. That's an interesting topic if anybody would like to discuss it. But nonetheless, he looks at expectations, not actual rates. Okay, so the Volcker Shock was a kind of economy-wide reboot. Many larger economic trends, which persist through today, either accelerated, appeared for the first time, and kind of altogether snapped into place during the global economic downturn brought on by the Volcker interest rate shock or by the macroeconomic expansion that began in 1983 and lasted across the 1980s and really concentrated in the US. These trends would include the rise of inequality, however you care to measure it, the explosion of debt across all sectors, household, corporate, public, reduced trend lines in productivity growth, reduced trend lines in economic growth, the kind of normalization of financial panics like we saw in the Mexican peso crisis in '82, the normalization of Fed bailouts in response, the feminization of the workforce, especially in the service economy, bulging U.S. current account deficits with the world, trade deficit, elongated business cycle expansions. I can talk about that, but the 80s is a 9-year, very long business cycle expansion. Happens again in the 90s, 2000 leading up to 2008. Okay, so in hindsight, very clear, very stark patterns. In real time, right? In real time, there's another possible meaning to the term Volcker Shock. It's true, high interest rates slayed inflation. But to read the transcripts of the FMOC, to listen to Volcker, he's often literally in shock, surprised, right? Surprised at the course of economic events and their seeming indeterminacy. So again, the theme, right, of the lack, right, of the ability to kind of see and create and plan for an economic future. The same would go for the Reagan administration, which I can talk about, but they came in thinking they would raise the savings rate. That went down. They came in thinking there'd be a manufacturing revival. That didn't happen. They came in thinking that if they cut taxes, it would lead to a surge in investment. That didn't happen. Kind of the opposite, right, of everything they said would happen as the result of their policies occurred. Okay, but the riddle here, I think, like the riddle here, if we're trying to explain the capitalism that opens up in this period, is how do you get, right? How do you get in real time a sort of everyday experience of indeterminacy, an everyday experience of instability and uncertainty in economic life, in which the man who's supposed to be in control, supposed to be responsible, Volcker, is throwing up his hand saying, I don't know how to do this. We can speculate about everything. How do you get that in tandem with, it's now possible to see in hindsight, like some very stark long-term patterns. And we could take the rise of inequality if you wanted to choose just one. Okay, so how did this happen? The Volcker Shock did more than induce this recession. It did more than induce this recession. It did two more related things. First, it fundamentally changes the character of U.S., the role of the U.S. in the international economy. It fundamentally changes that. And then second, it aided a new conceptualization of capital and investment among the U.S. owners of capital, particularly among corporations. So let me go kind of with the international and then come back to the domestic. So first, the global economy. Inflation was a problem everywhere in the 1970s, which was still, for most of the world, a decade of high growth, a decade of high commodity prices, especially oil, with the twin oil shocks of the 1970s, which contributed to inflation. Now, the Volcker Shock, raising interest rates in the core, as the US dollar was then, is today, the reserve currency of the global economy. Raising interest rates in the core, it raises interest rates for everybody, and it plunges the entire world into recession. It undermines world commodity prices. It brings down the price of oil, for one. So the price of oil for the US economy will not be a problem again until the 2000s, which is another boom decade for the global South, fueled by cheap money. The Volcker Shock also contributed to the Latin American and African debt crises of the 1980s. These are states that had borrowed heavily from US and UK banks during the 1970s. One of the reasons why there's a currency crisis in Mexico in '82 is because of the result of the Volcker Shock for squeezing the global economy. Second, high US interest rates. It recruits short-term liquid capital into Wall Street, into the US, seeking Volcker's high interest rates. So that bids up the dollar. You can see that here. Right? So the Volcker Shock really secures the global primacy of the dollar. At the same time, the high dollar, this is balance on merchandise trade, the high dollar punishes US manufacturers, particular steel and also auto, who are exposed to international trade competition, mainly from West Germany and Japan. Soon enough, other low-wage economies throughout the world, 1990s, especially 2000s, China. Third, especially with Reagan's tax cuts and military spending, increased military spending for the Second Cold War. Global capital imports fund the budget deficits and finance this U.S. trade deficit. During the 1980s, a lot of talk about Japanese savings coming into the U.S. To fund these deficits. Eventually, again, we get to China. This is net lending and borrowing. So the line goes up, that's basically capital coming into the United States. So what we get is a very strange environment for financial markets in the early 1980s. Very high interest rates, because Volcker is setting the interest rate to kill inflation, but abundant financing, right? Abundant financing at high rates. I'm going to say more about that. But in any event, kind of like flipping a switch. Within a few years, we have a very new kind of global economy. The post-war decades, the U.S., like many hegemon before, across centuries of world history, exports capital, right? Exports goods. That's what it means to be the hegemon. This new configuration, the U.S. imports capital, and it becomes the consumer market of last resort for the world. That's unprecedented in economic history. We've never had a hegemon in which capital, the expression is capital is running uphill, right? Running uphill into the United States. Furthermore, I'll get there, but the magnitudes of these flows is going to increase dramatically with globalization. Okay, to go from the global to the national, how do these global changes manifest in the U.S. national economy? I want to start with the recession of 1980-82 briefly, and then turn to the character of the post-83 business expansion, which lasted until 1990. It was new and shares in common many characteristics with every future business expansion, including the one we're living in today. Okay, between 1979 and 82, there's a massive purge, a corporate purge of unprofitable fixed capital investment, those factors of production in the historic Northeast, Midwest U.S. manufacturing belt. It's been the anchor of the U.S. manufacturing economy really since the 1850s, really. The EPA takes all these beautiful pictures of smoke in the 1970s, so you have all these wonderful photographs of factories. This is the Bethlehem Steelworks in Lackawanna, New York, that shuts down in this period. Now, in some respects, this purge has been a long time coming. In U.S. manufacturing, the 1970s was a decade of, quote, profitless prosperity, as it was called. High levels of investment, high levels of fixed investment, very low profits. Now, what's changing during the 1970s, and I could only describe this very briefly, was a new conception of capital, a new corporate conception of capital. It comes from U.S. business schools, comes from consultants, it comes from financial economics. In the portfolio theory of the firm, rather than fixed physical assets, the corporation's capital consists of competing financial claims on resources, each promising their own risk-weighted expected return on equity. And portfolio theory, very honestly, makes heroic assumptions about liquidity, about the fact that corporations could transfer their assets at whim without friction. And this sounds quite obvious, right? The factory is not profitable, shut it down, divert resources to more profitable channels. But in corporate governance, the Volcker Shock is a very critical juncture. In post-war decades, interest rate accrual, just putting money in a bank and making money off of interest rate accrual, accounted for about 1% of the profits of non-financial corporations, 1%. Between 1979 and 1982, with the high interest rates of the Volcker Shock, the number is 31.4%. Right? So the first strategy you see is with high interest rates, instead of investing long-term, just park money and earn interest rate accrual short-term. But again, it's a response to uncertainty that's shifting capital into the present moment away from the long term. It's liquidity preference in that sense. Now, interest rate accrual is a component of financial or portfolio income. So for manufacturing firms, in 1978, portfolio financial income was 18% of total profits. By 1990, it's 60%. So by 1990, manufacturing firms are making the majority of their profits through financial strategies. That number, it's about 42% now. It's never dropped below 40% since the 1980s. So what happened? I mean, how did this come about? One corporation I'm interested in is Union Carbide, which is a petrochemical company. I'll explain why in a minute. During the period 79 to 82, during the Volcker Shock, it just massively disinvests from old fixed capital in the Midwest and the Northeast. It shifts to portfolio income strategies. It also begins to invest in polyethylene plants in Houston. We're about to go to Houston here in a minute. Here's how Union Carbide managers describe their changing conception of capital investment in this period. This is from a 1985 interview, but I could, assemble thousands of quotes that sort of sound a lot like this. Okay, this is like a mid-level manager of Union Carbide. Quote, "I think the basic problem of our business model in the 1970s is that we fell in love with our production process. It's such a miracle to make the whole thing work that sometimes we forgot it's a business. That's the only reason I can think why we put so much capacity into unprofitable plant. Today, the disease is compounded by change. Right? Things are moving so fast that it's absolutely necessary to avoid heavy commitments." So again, that's liquidity preference, right? That's this feeling of uncertainty in business that's inhibiting long-term investment decisions and leading to different kinds of strategies for realizing profit. Similarly, if you ask, how are these changes experienced by ordinary folk? Now, we have many great ethnographies of this moment of deindustrialization, the 79-82 purge. My favorite is a book called Rogovan and Frisch, Portraits in Steel, which is about the Bethlehem works in Lackawanna. So this is Benjamin Buffer. When corporations disinvested from these factories, again, it's experienced as a kind of shock. This is Buffer, quote, "Well, things were going pretty good. Plants going like crazy. And then all of a sudden, things fell apart completely one day." This is Buffer and his wife. This book's great. It's fantastic. This is Kenneth Sion. "Everything was booming, and then all of a sudden, one day it stopped. Just like that." So that's not true at all. I mean, things had not been booming in the U.S. steel industry for some time. But again, people are experiencing these changes as a kind of disorientation, right? A kind of, again, shock. Meanwhile, with this shift away at the corporate level from fixed assets, this is Sion and his wife, away from fixed assets, there's a new ideology of corporate governance that ascends after the macroeconomic recovery begins in '83. What's called shareholder value, in which company stock, right, the price of the stock, becomes the chief metric of corporate success. Now, what's the lever to achieve that? It's a new debt market, a new capital market in junk bonds that funds leveraged buyouts and the corporate strategy of downsize and distribute, right? Purge fixed cost, purge long run-turning costs, whether it's fixed capital or labor costs, and distribute resources to maximize immediate short-term shareholder value. Now, to do so, the U.S. corporate sector across the 1980s borrowed heavily, right? Doubles its level of debt. What makes that possible? Again, you have to bring in the global dimension to this. All this capital running uphill into the U.S. market from around the world. Now, very quickly in the 1980s, new distributive patterns start to take shape. All right, this is a political economy of what I call asset price appreciation. Right? Income growth before 1980, the post-war period, is tied to the depreciation, right? The depreciation of capital. You build a factory, you produce income, profits, pay by using the factory, right? The value of the factory depreciates across time. Thing about illiquid fixed capital, it's stuck on the ground. It can be contested by workers, right? It can be contested politically. It can be taxed, right? This is a political economy that's organized around pay, right? Around income yielded from investment in fixed assets. This post-war capitalism, you can see here it links the average rate of pay, labor compensation, to the growth rate of productivity. Right? The central figure here, I mean, the absolute central figure is the white male breadwinner. Right? That's the person this political economy is geared towards benefiting. The political economy fits and starts. It comes out of the 19th century. It comes out of Industrial Revolution. It reaches its sort of culminating phase in the decades after the Second World War. After 1980, after the Volcker Shock, we're going to produce fresh income with a relative shift away from pay towards capital by liquid assets appreciating in financial markets, right? Not depreciating fixed capital, by appreciating capital assets. And you're going to use debt and you're going to use leverage, right, to lever up profits, right? So the stock market goes up, real estate prices go up, they throw off income, they create jobs, but in services, whether it's the high-wage regions of the service economy, financial, business services, or low-wage, historically feminized jobs in services, retail, nannies, home health care workers, and so on. The post-1983 business expansion, 83 to 1990, is the only business cycle expansion on record. It's the only one for which we have the numbers for, at least, with a declining share of fixed investment in GDP. And, Reagan said if we cut taxes, right, people will use the money that hadn't been taxed to increase investment. Didn't happen. We'll see what happens with the Trump tax cut, but so far it raises questions about whether or not that strategy will work. Again, this is fixed. This is for the U.S., and just so you see it, this is for the world. So similar kind of global trend, too, with respect to fixed investment relative to GDP. What's the distributive pattern? 1980's largest run-up in U.S. wealth inequality of any business cycle expansion on record, right? It's a very long expansion, but it rewards not labor through pay, but owners of property, owners of capital, again, through asset price appreciation. And of course, you're going to increase inequality because you have to own property if you're going to benefit from income earned from property as opposed to labor. It also has a very striking spatial dimension. So if you go to the top 0.1% of the wealth distribution, the capital gains of the 1980s, it ends up in like 5 counties. You could probably guess them. I mean, because of Reagan's military buildup, Washington, D.C. does really well, but also New York, very central to this economy with the rise of kind of Wall Street in the 1980s. Okay, so what you have here, first you start with these interest rate accrual strategies during the Volcker Shock, 80-82. Then it's just off to capital gains in various different markets. Commercial real estate, really important to the 1980s. That's where Trump comes from. Stock markets, another important market across the 80s, all leveraged up by debt. So Volcker slays the inflationary dragon. It's a great achievement for it. He's celebrated. I like Volcker. Read his memoir, especially undergraduates. It's very edifying. He's a very committed public servant, very admirable. At the same time, I'm arguing there's sort of unintended consequences to the Volcker Shock, which we still live with. So when you raise interest rates that high, whether we're talking real, I think the nominal effect is interesting, but even at the level of real, accounting for inflation, what you do is you create a very high hurdle rate for profitable long-term investment. Right? You need a very high expected rate of profit to hurl over what you can get from just parking your money and earning interest, not to mention if you want to borrow money to invest, given the high rate that you have to pay back. One way to do that, right, to achieve such a high profit rate, is to use debt, right? Is to borrow money to invest as opposed to using your own capital. Again, because of the global dynamic, all this capital running uphill to the US, in search of those high interest rates, you get this really weird moment in the 80s, abundant financing, high rates. And it snaps in a kind of investment mentality, I'm calling it liquidity preference, And even when you get into the 90s, 2000s, and afterwards, when interest rates go down, right, the same phenomenon exists. Okay, so what are the attributes of liquidity preference? Well, it's this withdrawal into the short term. Lack of a long-term vision, lack of commitment, lack of planning, and emphasis on mobility, convertibility, and uncertainty. So let me just, I'm going to run out of time, but let me just conclude by taking a quick look at the character of this post-83 expansion. I want to go now from the global to the national to the kind of urban scale, a little bit closer to the ground, and just talk about Houston, which is like a section of a chapter in this book. I'm going to run out of time. Do I have like 5 or 10 more minutes? Is that okay? I'm putting you in charge, Herschel. Thank you. Okay, so Houston's already the fastest growing city by any measure across the 1970s, which reflects a regional trend. Volcker Shock depresses Houston's economy. The recovery after 83, despite low oil prices, Houston booms again. It's still the fastest growing city in the US. This is downtown Houston in 1980. This is downtown Houston in 1990. Okay, so we're getting an economic boom in the US. Like, what does it look like on the ground? Beyond, Wall Street. So Houston's like a microcosm of everything, right? You have sort of every single post-1980 trend. Global capital flows coming in, feminization of work, rise of service economy, inequality, debt, low productivity growth, a kind of entrepreneurial, self-hood, thoroughly automobile-based city that's sort of doubling down on fossil fuel energy consumption, privatization in institutions of political economy. It's all just kind of piling up, and it ripples out from places like Houston, other cities too, Dallas, Phoenix, and it sort of plays nationally. Other really dynamic places in the US, there's only one Wall Street, there's only one Silicon Valley, but again, this kind of dynamic of growth that we see in Houston replicates. This theme of uncertainty, theme of indeterminacy. Houston's a quote, planless city, no city planning commission, no zoning ordinances. So builders sort of build anything. You can build anywhere you like. This is Houston's urban sprawl. So you can fit Chicago, Philadelphia, Detroit, and Baltimore in it. And then this is New Jersey inside the Houston metro area. First-hand descriptions of Houston from people who migrated there in the 1980s. Houston is, quote, elusive, a conundrum, hard to pin down, a chameleon. Houston is a city 3/4 of which sometimes gives the impression of being at the edge of town. And then Houston, this is the New York Times, Houston, quote, is a soulless version of Los Angeles. Ouch. Okay, if you're interested in postmodern architecture, see me after the lecture. Let's just skip that slide. All right, oil refining and petrochemical plants made Houston by 1979 the 4th largest industrial city. It's also its rank in population. Its manufacturing labor force is lean, it's low wage, it's not unionized. The AFL-CIO is just sort of reeling from these plant closures in places like Lackawanna. It tries the organizing drive in Houston in '82 and it fails. Now, nationally, real hourly compensation for men flatlines after 1972. But in Houston, with the absence of high-paying male unionized manufacturing jobs, male wages for a long time have been below national average. So already during the 1970s, Houston has the highest rate of female labor force participation in the US. This is the national trend. That means household income inequality nationally rises across the 1980s. But nationally, it's tempered by the dramatic entry of mothers with children less than 5 years old into the labor force. But that dynamic's already played out in Houston. So household income inequality surges in cities like Houston across the 1980s, and then the national trend catches up by really the 2000s. Okay, Houston's growth is spatial. Its largest growth sector is real estate development. High turnover rate, build, tear down, build, tear down. Funded by New York banks, also global capital. A lot of Middle Eastern sovereign wealth funds bringing money into Houston through Houston's energy elites. Also Latin American capital, fleeing things like the Mexican peso crisis of 1982. Real estate, highly leveraged, speculative. Houston's ground zero for the savings and loan commercial real estate frauds of the 1980s, but also residential real estate growth as well. Very high rates of debt, right? High rates of mortgage debt. So little employment growth or wage growth from industry, but the built environment is moving rapidly across space, right? Which is one reason why the city is elusive or, quote, not perceptible. Growth in the service, retail, domestic, temporary, healthcare, food preparation, childcare sectors, all low productivity, low wage sectors of the economy. Of any city, Houston has the highest number of female domestics, maids, nannies, home healthcare workers. So nationally, 90% of the jobs created in the post-1983 expansion were in either government, temp work, schools, healthcare, or retail trade, 90%, which finally moved service employment past manufacturing employment for the first time in US history. Okay, so there's rising pay inequality, there's flat real wages, but a very high rate of home ownership, although through mortgage debt. So everyone's starting to learn how to play, trying to play, this asset appreciation game through property, right? As opposed to the increase in pay game through labor earnings. But again, if the game is property, you're going to see more inequality because the rich own more property to begin with. That's what makes them rich. Okay, one more thing about Houston, and I'll stop. Two more things about Houston. So the Reagan administration comes into office promising to slash welfare expenditures. It slashes for the most vulnerable, for the most poor, but in total it fails. But it does privatize social service delivery. So Houston has high concentrations of poverty, a real dearth of public services, especially housing. And Reagan sought to replace public welfare with private charity, as well as to channel more welfare delivery through nonprofits. It's very easy to do in Houston, where the state infrastructure was so weak to begin with, given that the city is so new. Like the New Deal state didn't exist, the city wasn't there. So therefore, religious nonprofits become important and increasingly deliver welfare. Or Reagan slashes the public housing budget, but an 86 provision in the tax code lets for-profit developers buy tax credits from nonprofit intermediaries to build low-income public housing. So there you go. Convertibility, both with respect to capital, but also with respect to institutions, or even thinking about gender roles at work, right? So this political economy, asset appreciation, but it's also a political economy of corruption. Not corruption in the sense of nefarious deeds, although there's plenty of nefarious deeds, but in the sense that institutions become shape-shifting, right? Public and private, for-profit, non-profit, home and work, male, female, they seem to be kind of changing out for one another, which again is another reason why a city like Houston is so hard to perceive, so disorienting if you have the kind of old industrial structure in mind. Okay, now I'm really going to finish. So the Volcker Shock just buries post-war industrial society, right? It's gone. And as far as I'm concerned, that's great. That's a real achievement. Political economy diverts income through pay, through the white male breadwinning wage. Sponsored by all these global capital inflows, not happening anywhere else, only happening in the US. The US economy is able to liquidate, literally, industrial society and start to create something different, right? A city like Houston. I'm from Houston and I like it. I like it. Other countries don't have this opportunity. I mean, communist countries experiencing industrial malaise in the 1970s, they binged on debt, right? They binged on debt from global capital markets too. Poland, East Germany especially, they still fail, right? They still fail. You go to places in Western Europe, you don't see a lot of cities like Houston. They don't really exist. Post-war period, unemployment's a much bigger problem in the US than it was in Western Europe. During the 80s, we see it flip because the US is capable of generating new kinds of employment in the service sector, whereas Western European economies can't because they don't have this kind of spatial frontier of cities like Houston, Phoenix, Tampa, so on and so forth. All right, let me finish with two thoughts. So this 80s pattern, this is just stock market capitalization to GDP, over shares of investment to GDP. This kind of economy that comes together in the 80s, it just expands across the 90s and 2000s. This is the current, what is this? Current account balance. So this is index, right, of the kind of globalization of these new flows. You can see the 80s is kind of minor compared to what's coming in the 1990s and 2000s. So I think the 80s, again, is the birth of our economic present. And then finally, liquidity preference, right, which is a preference for the short term, the kind of trapping in the present. So we've kind of killed off post-war industrial society, right? But it comes with this kind of lack of long-term vision, long-term commitments, or an ability for collective institutions to kind of reach out to the future. What's the political response to this? You can see it already by the mid-1980s. It's a kind of politics of nostalgia, right, for the past. It runs from right to left. Certainly a politics of nostalgia for the past breadwinner, female homemaker family. A politics of nostalgia on the left for post-war social democracy. Maybe, right, there's a moment, late 1990s, kind of Clinton, liberalism, sort of third way, embrace of globalization, that is a kind of positive vision about how to move beyond the past. But that didn't work. Didn't work. Okay, so liquidity preference at the most pathological extreme, well, at the most extreme, is a kind of pathology, right? It is a kind of inhibition, sort of locks you in the present and only leads to a kind of politics of nostalgia for the past. So the question, right, posed by that analysis is how do we find resources in our politics, in our collective institutions, to invest in it and create a long-term economic future worth having. Okay, so thank you for your attention. I'm going to stop there. We have time for question and answers. Please wait for the microphone before asking your question. Thank you. Any questions? Especially down front. Any questions? Comments? Here, but please wait for the microphone. And then speak into it when you speak.
Yeah, so recently we've had more, like in the public discourse, we've had more of a return to the idea of like the New Deal liberalism. And so why, might be too big of a question, but why would you say it failed and needed the Volcker Shock to maintain the U.S. economy?
Why did New Deal liberalism fail?
Yes.
Yeah. That's a great question. In a tweet, yeah. The question was, why did New Deal liberalism fail? Well, if we look at the kind of crisis decade of the 1970s, right, every aspect of New Deal liberalism is in crisis. So first, if the whole political economy is anchored to the male, white, breadwinning wage, that's flatlined, right? That's a problem. Second, productivity slows down. You kind of, now there's debates about this. Some attribute to the oil shock. I think you kind of squeezed out all of the productivity gains you can get from a Fordist assembly line. But if the political economy is increased upon, or premised upon increasing consumption, higher wages, productivity flattens out, you have inflation. So inflation is the telltale sign. But I see it as a broader political, economic, social, and cultural crisis, also at the level of the household. Now I also think, and this fits into my last comment about just giving up on nostalgia for the kind of New Deal liberalism, that it never really worked to begin with, in part because it doesn't get control over the investment function, which I see as like the crucial terrain in a capitalist political economy. Why did the Great Depression end? It ended because of spending during World War II, in which there was significant public investment, not in good, necessary things, but not in things we'd like to have, more bombs and tanks, things like that. Post-war conversion, there's a return to kind of putting investment in private hands, and that, much longer story, but I think already by the 50s and 60s, you can tell that the New Deal political economy has serious fault lines, which become exposed in the 1970s. There's a question here. The microphone's coming.
A comment, then a question. I guess my comment would be there's no question that there's unintended consequences to the Volcker shock. But what follows thereon is a 35-year bull market in bonds,
Yep,
lowering the cost of capital for the corporation,
yep,
the very event that should have led to a longer-term view
yep,
of investment.
yep.
Did you, in your analysis, try to attribute the emergence of financial engineering
Yep,
to that rather than the Volcker shock?
yep. Yeah, I mean, that's a great question. So the question has to do with financial engineering and what follows from the Volcker shock. And I think you put your finger on kind of a point in the talk that really deserved a lot more elaboration and explanation, is where do these kind of financial strategies come from? So I just have two thoughts about that, which to try to answer the question. One is you're precisely right that what an extraordinary opportunity in the 80s and 90s to make investments, right? Given that the Volcker shock worked, it created stable prices. Given that because of the way the global political economy is configured, you have all this money coming in because the cost of capital went down. So we blew it, I mean, it was a real chance to chart a post-industrial future worth happening. And instead we did something else. Now, you're exactly right, there's proliferation of synthetic financial strategies. One that I would point to that also comes out of the 80s has to do with derivatives and a belief within financial markets that you can hedge risk by creating new financial securities again and again and again. During the 80s, in part because we have floating exchange rates, it starts with hedging interest rate risks in global currency markets. It moves to hedging risks in corporate defaults. It ends up in mortgage debt. So I think from this moment, you can trace the emergence of all these new kinds of financial engineering in which the idea was, right, this is not just the right, this is Clinton too, right? This is his economic team, Rubin, Summers. The idea was if you liberate capital markets, right, capital A is going to flow to the best possible return, and then two, it's capable of hedging itself through new kinds of financial products. And instead, I think, I mean, this is a debate worth having, but I think you get a lot of antisocial activity in financial markets, and you get a lot of hedging, or what's presented as kind of hedging and securitization, that turns into kind of all kinds of new forms of short-term speculation that inhibits the kind of long-term investment that we've been talking about.
I'm kind of overwhelmed with the information here, but my question is does it seems as though if liquidity is the way to maintain an income, a continuing income, if you have money, and if that creates instability in the markets, it seems to be a cycle that reinforces itself and goes faster over time. If that's happening, what's the way out of this particular paradigm, or maybe there isn't? What do you think?
Yeah, so the question was about, there was a number of points you brought up that I think are worth addressing. One is that, liquidity isn't all bad, right? Having money as a store of value isn't all bad. I mean, Keynes talked about three motives for liquidity preference: speculation, hoarding. Speculation can sometimes lead to investment. That's okay. Hoarding is kind of always bad. And then what he called the transaction motive, because you need to save money to spend at different points in the life cycle. Businessmen need to stretch out payments over the course. So one, I'm glad you raised that point because it bears mentioning. Second, yeah, I mean, you're talking about a repeating credit cycle in which you have waves of speculation that lead to investment, but then are followed by panics in which the Fed becomes the lender of last resort. Now, across the 80s, 90s, and 2000s, it looked like the Fed could do that without there being major macroeconomic consequences. And in fact, Ben Bernanke, who was chair of the Fed in 2008, gave a speech in 2004 where he talked about the great moderation. And he said, actually, since the 1980s, since the Volcker shock, because of price stability, we have these very long business expansions, and we have less macroeconomic volatility than we had in the 50s and 60s. Now that's right, because as long as the Fed, right, can support beliefs in capital markets that there'll always be liquidity, always a willing buyer for your asset, always credit available to roll over your loans, right, you can sustain very long business cycle expansions. The problem is what happens when the cycle reverses. And we're at a vicious trap. And I think all you have to do is read the newspaper. I mean, the Fed talks about raising interest rates, normalizing monetary policy. Last year, the stock markets go down. Finally, 2-3 weeks ago, the Fed says, okay, we're going to halt. Markets go back up. How do we get out of it? I wish I knew, but I do think the critical institution is the Fed. Now, you talk about politicizing the Fed, people get very uncomfortable because for 30 years we've been celebrating, independent monetary policy, and there is major risks to politicizing monetary policy with respect to inflation. But I don't see any other way to change this dynamic than making monetary policy much more unconventional, than it's been since 2008. Here.
Hello. So I guess I kind of have a two-part question.
Good.
You talk about liquidity and illiquidity, and a lot of times and I know you're talking about in this specific time area, you're talking about factories and things like that, but a big factor of something that we park a lot of our illiquid assets or intangible assets into is things like R&D. And when you're looking at that and you look at general macroeconomic growth and things such as TFP and in the Romer model, I would argue that a lot of growth is driven by that accumulation of money spent into R&D. And so when you talk about how we are becoming increasingly focused on liquidity, how do you accept that along with the growth in areas such as biotech, where we're spending a lot of money on intangible, illiquid things like R&D?
Yeah.
And then I guess second of all, not to cut you off,
Do your second part, because the first part was great.
is when we're talking about more modern instruments, like when we're looking at venture capitalism and all of that in Silicon Valley, and you're starting to have all these companies with IPOs, and their balance sheets are completely ridiculous, and they're massively in debt all the time, not posting any profits. Do you think that's just a modern way of financial engineering to work around this more liquid mentality that we've developed?
Yeah, just a fantastic question. Both parts, which really do relate. So the first question has to do with, if I could paraphrase you, wait a minute, this whole fixed capital factories is an out-of-date way to think about where capital goes and where growth comes from, right? Actually, we have a lot of economic models about endogenous growth. That growth comes from creativity, it comes from innovation, it comes from knowledge, from things that our national income accounts don't measure so well, including the statistics that I'm using here. I think you're exactly right. I think that perspective is needed at minimum to talk about inequality or to engage debates about whether or not education or disparities in education, human capital, are driving inequality. I was almost going to say read my book, but that sounds really awful. But I think that you have to look at human capital, social capital, different kinds of capital in addition to the liquidity, illiquidity. So you're right. The second part, though, I think is really interesting, because the fixed capital of the factories, because they raised productivity, they made profits, right? A lot of these new industries in technology, biotechnology is one of them, they don't have a lot of fixed costs. They have a lot of investment in intangibles, but they have a very hard time making profit, right? A very hard time making profit. So how do they actually make profit? They don't do it, right, by making a product and selling it above cost to a consumer. Instead, they do it through asset appreciation of their stock, through initial public offerings and stock sales. I was at a talk not too long ago with an executive from eBay, right? And he said, how can you compete, he's talking about Amazon, how can you compete against a company that doesn't want to make profit, right? Like, how do you do it? Amazon doesn't want to make profit. They're investing in cloud computing, another kind of intangible. They have huge revenue growth, but they're not making profits the way an industrial corporation like General Motors was trying to make profits and succeeding in 1960. So I think you have your finger on a very important shift in how valuation is occurring. And I don't think we know which way it's going to go. Some companies, Facebook being one, has figured out ways to monetize their business to actually make profit. Others haven't yet. And it's not clear what's going to happen. Question right behind you, right behind you.
Thanks so much, John. It's always stimulating to hear this kind of synthesis. I really appreciate, I can't wait to read this book. I'm curious the extent to which you referred at one point to the missed opportunity of the chance to actually insist that all that liquidity become investment. I'm curious the extent to which you tell this as a political story, because of course that was an outcome for which the beneficiaries of it fought for, almost from the end of World War II. And to think of this as, or to allow there to be a perception that this is the action of market forces beyond our control. I know that, because I know your work, is not how you write about it, but I'm curious to what extent the political battle to free that liquidity, to turn finance into the driver of the economy with absolutely no restrictions on how that was going to redound to the experience of the rest of the country. To what extent is that part of the story that you're telling in this particular book?
To try to answer that question specific to this moment, to just talk about the Reagan administration, and there's a number of phases of it. The first phase is what they say what's going to happen coming in. Right now, first, when Reagan comes in, he campaigns on the gold standard. He doesn't like the Fed at all. He's not necessarily in favor of the Volcker Shock. It happens, he lets it happen, but it's not part of his agenda coming in. But he does have a program, cutting welfare expenditures, cutting taxes. And they make a series of predictions about, what is that gonna lead to? And 83, 84, it's very clear that the opposite happened, right? The opposite happened. They say, right, if you want to put it in the most simple ideological level, they say, let the market decide because the market will discipline. The problem in the 70s is inflation. People are spending too much, they don't save. Markets will discipline. Instead, markets do the exact opposite. You have all this money coming in from abroad, and there's a kind of just massive opportunities to speculate and invest anywhere you want. So that happens. That's the first step. The second step is they start to think about it and absorb it, and they move in two directions, very smartly politically. First, they say, wait a minute. We can fund budget deficits to kingdom come, right? Of course, this is Cheney's famous comment at this period. Reagan proved that budget deficits don't matter when they do the same thing again in the 2000s with the Bush tax cuts. So they kind of realize, okay, there's ways that this new configuration can work for us. And then second, very smartly, they do play this politics of nostalgia. You can see it in two places. One is the Farm Bill in 85 and 86. Everybody remember like Farm Aid and the farm crisis? It's kind of Jeffersonian, farmers who are in debt. It evokes populism, right, really, in many respects. And Reagan, who says, there is nothing more, any farmers in the room, I apologize, but there's nothing more bloated in terms of when Reagan talks about how the state leads to corruption and private interest. There's nothing more like that than the Farm Bill. 85, Reagan signs a Farm Bill with the largest handouts to the farm sector in the history of the country. And he does it, playing with this rhetoric of kind of we need to restore our producerist heritage. And there's Willie Nelson, on the stage at Farm Aid kind of talking about these values. Industry as well. So if you go to these, look at this. There actually is a shift in 85. Reagan intervenes in trade policy. This is called the Reverse Plaza Accord, where Reagan's Treasury officials meet with the Japanese and the Germans to bring the value of the dollar down to help U.S. manufacturers that are just being, hammered by exports. So they're, in the politics, Reagan, his administration, they do adjust. They do practice this politics of nostalgia, I think. And then finally, they actually kind of tamper it down. And then I should stop talking, but you get in the 90s, the Clinton, they play out the whole thing until Rubin kind of takes control, Robert Rubin takes control of Clinton economic policy making in 94. And then they just take that 82 to 85 pattern and just expand it at a scale that not even the Reagan economy had accomplished. Question here.
So you mentioned charting a post-industrial future worth having. And it seems like from the chapter of your book we read for class, it's kind of like a shift from manufacturing to probably tech and finance becoming more important. And I don't think you're like necessarily inherently negative on finance, but you mentioned antisocial activity. And so I'm wondering what kinds of like pro-social, if that's the term, or like what kind of sectors are you excited about right now?
Okay. What kind of sectors am I excited about? I don't think you. I don't think you mean like stock tips, which I should definitely not be giving. Look, I think this issue. I think gender is like this is the key issue, right? When I was talking about that politics of nostalgia having to do with white male breadwinning, if you look at the service economy, okay, the high end of the service economy, antisocial activity, absolutely. If you look at the low wage, I had all this stuff that I cut out of this talk because it was too long. If you look at the ethnographies from the 1980s and the 1990s, about the best was probably Ruth Milkman, who's a great sociologist at Rutgers, I think, has a book called Farewell to the Factory. It's about GM auto workers, and they lose their jobs, and it's horrible. They lose their pensions, they lose their kind of social connections from the factory. But basically, none of them are that nostalgic for the job itself. The job's horrible. You work on an assembly line, you have a boss yelling at you all day. A lot of them get new jobs in things like laundromats, roof cleaning, kind of services. They always report better job satisfaction. The actual content of the job, because it's more social, doesn't pay as well. So many of those jobs in the service sector are care work, are effective labor, a fancy term used by people, used by historians and sociologists. They're absolutely pro-social. There's tremendous employment growth or tremendous employment demand for categories like nurses or home health care workers. Now, those jobs have a pro-social dimension. The problem is they're not remunerated. They're not paid enough, mostly because they're in categories of the labor market that have been considered women's work that received unequal pay. So I think, and this has to do with the future of work, this has to do with automation and basic income, I think there's lots of jobs that, Bethany Morton's written about, I'm stealing Bethany's work to some degree. There's some jobs, right, that in the service sector that we shouldn't think of as just being horrible and degrading, right, but actually have a kind of social content that's worth appropriating. They just need to be changed in all other kinds of respects in terms of pay and other dimensions. Thank you so much. Thank you.